Now we can see this play out even more specifically when we look at sort of the growth rate in two different firms here. Okay, so in this graph, what I show is the growth rate over time for Walmart and for eBay, and this will hopefully help illustrate the difficulty. And remember, all of this goes back to the key value driver formula. We're assuming the growth rate in that formula is constant over time. And what I want to demonstrate to you is that that is not likely to be the case, particularly for certain firms. So we have to be really cautious here when we're thinking about applying this formula and when we're advising managers on growth strategies about just how sustainable growth strategies really are. Okay, so look at these strategies, right? So for Walmart, it is a good. We would be comfortable assuming that the growth rate for Walmart was stable over time, because for almost 40 years they had a 10% growth rate in revenue. Right? They did not reach maturity for like 45 years, meaning now Walmart is at maturity. They have a Walmart everywhere in the U.S. that they want. They've opened stores in other countries. They basically have a Walmart everywhere they need to have a Walmart, or they want to have a Walmart, right? But it took them a long time to do that, right? So about 40 years, they had a 10% growth rate. So that means if we were using the key value driver formula and we plugged in 10% for Walmart's G, we would be pretty confident back in the day that this was a good model. On the other hand, eBay, I mean, look at eBay. They had like 100% growth for like 5 years, 80-90% growth for the next 5 years, and then within 15 years they were basically at 0% growth. They grew absolutely bonkers as fast as they could, but within 10 years their growth rate had bottomed out. They weren't making any additional revenue because they had introduced everyone to their product that was interested in being a part of it. Right? Now think back to what the return slide, when we were actually talking about what sustainability and why these two firms might be different, right? Capital intensity. Walmart, hugely capital intensive, meaning for Walmart to continue to grow, they had to build these massive stores over and over and over again in different places. They had to build out warehouses and distribution centers. They had to build logistic companies. They had to have trucking and shipping. They had to find all their suppliers. They had to do a whole lot more to continue to grow than eBay. All eBay had to do was add servers. And so when customers came, they added some more servers, they got bigger, boom, they're done, right? So they get huge growth, and then they stop because eventually they rise, they saturate their market much quicker than Walmart, right? So one of the ways that we might think about growth and whether a certain growth strategy is reasonable or sustainable within the context of our value model is that a firm that has high capital intensity, needs a lot of capital, can sustain a stable growth rate for a much longer period. So our model is going to do a much better job in that situation than, for instance, eBay, right? Because if you looked at eBay in year one and you were trying to value eBay, you would see 100% growth, but you would know that eBay can't sustain 100% growth. No firm is going to double forever, right? So then you're stuck in this position where you're trying to say, okay, well, eBay doesn't have a lot of capital intensity. They don't need a lot of capital. They're going to have high returns and high growth for a while, but that's going to level off and it's going to do so quickly. How do we incorporate that into our model? Now we'll talk about strategies later on in the class, but that's what we're trying to get at here, right? So this model is going to be a lot more effective if we can be confident that that firm that we're actually looking at can sustain a level of growth over a period of time. And it's more likely to be that way if the firm has high capital intensity. Okay. The other way, or the only other way for firms to sustain high levels of growth is to move outside of their original packaging, their original market, right? So the only way to consistently achieve high growth is to move into new product markets, right? We can't eventually, like we saw, eBay was, I don't know if you remember, but when eBay originally started, it was just an auction place. So you sold your junk at auction, and eventually they reached everybody who was interested in buying junk at auction. So what do they have to do to keep growing their revenue? They have to move into a new product market. So now eBay acts kind of like Amazon. You can buy anything on there. Walmart is doing the same thing. They have, basically now reached market saturation in terms of the retail spaces that they want. So they try to move into new markets. That's why they started putting things inside the stores, like the eyeglasses centers and the banks and things like that. They also, are trying to compete with Amazon by having a huge online marketplace. They have bought a bunch of like clothing stores and things like that. They are trying to move into new product markets. And you have to do this consistently and successfully. And most importantly, you have to do it in time, right? You have to get into the new market in time to enjoy the phase of the revenue growth before the market gets saturated and you're left just holding a small slice of the pie, right? And some firms are really successful at it and some firms aren't, right? For instance, Procter & Gamble had $1 billion brand in 1999, and by 2013 they had almost 20 individual brands with $1 billion in sales. So they have been enormously successful at moving into new product markets at the right time and building a really strong brand that then continues to get the company to have overall revenue growth, right? And so you see this sort of across the board. Like, this is the only option for any firm. If we are going to expect that a firm has a continuous revenue growth rate over any period of time, they must move into new product markets, okay? Because otherwise they're just going to saturate their market and then they'll peter out and they won't have any revenue. Well, they'll have revenue, but no revenue growth. So you see this across the board. Amazon starts off by selling books, then they start selling everything. Now they make the majority of their revenue by selling computer space, server space, something called Amazon Web Services. They host other people's websites for them. And that's like 40 or 50% of their profit, and like 20% of their revenue comes from that. And they're moving into other things, right? They're trying to establish a health system. They're trying to establish an internet provider. They're trying to continue to move because that's the only way to continue to grow. And Google, of course, has a really obvious track record there because they just introduce new products all the time. Start by search, then they have Gmail and G Calendar, and they had a social media website for a while. They do Google does basically everything. I can't list it forever, but they're trying to move into new product markets because they're trying to sustain high levels of growth. Okay, and this is literally the only way it works. Otherwise, we would have to assume, like with eBay here, that within 10 years, eBay would have zero growth. And that's not going to create a lot of value for the firm. They have to try to generate a new product market and move into it in time to establish more growth. Okay. So, is industry growth sustainable? I hopefully have impressed upon you the fact that it is maybe for a short term, but in the long term, it's not. Because ultimately, every industry is going to saturate its market. And you can see that here. This graph's a little bit hard to read because there's so much stuff on here. But essentially, these are just a bunch of major industries. And the growth rate for those industries over the last 4 decades, right? And what you'll see is that you'll have a period of little growth, then you'll have a period of high growth, and then you'll have low growth again. Because they grow, they saturate their market, and then they move on, right? So industry growth is not very sustainable. Company growth is only sustainable if the companies continue to be nimble and innovate and move into new product spaces. Okay. Now, we can look at the empirical data here. The empirical data is not as clear. It's not going to be as comforting as the empirical data and our analysis of return on invested capital. And that's because of all the things that we just finished talking about. Growth is not as consistent. It is not as stable, and it is not as sustainable as return. So our assumption about growth in our model of value is going to be the worst assumption that we make. It is going to be really impactful, right? So what our choice of what the future growth rate for the firm is going to be will really impact value. But we have to recognize that we're going to make big mistakes here and that it won't be as sustainable and as high as we expect. In fact, the takeaways here is that the growth rate is relatively low, about 5%, right, over the last 50 years. And high growth rates, companies that have really high growth, they decay. That growth rates decay really quickly, and they decay back down to the median. Okay. So let me Let me show you what that looks like in this graph. Okay. So here's it. Remember that I showed you a similar graph for return on invested capital, where I separated all these companies into quintiles. So companies with high return, then middle return, then low return, etc. And I hope remember that, or just go flip back, that those lines never crossed. Companies with high return stayed high return companies. Companies with low return stayed low return companies. And not only that, they were relatively stable. So if you had a 15% return, 15 years later, you probably had also still around a 15% return. You maintained that growth. It was constant and stable. For growth, that is absolutely not the case. Right? Companies with high growth, that growth rate decays very quickly down to the median. Companies with low growth rates, their growth rates tend to increase quickly towards the median. And ultimately, over a 5-year period, all firms tend to just collapse into the middle, and we have just the median growth rate being 5%. So what this is going to indicate to us when we're doing our modeling is that we can't take the company's current growth rates at face value. We're going to want to look at the historical growth rates that they've enjoyed. We're going to want to try and understand the strategies that they're going to try to put in place in the future. And we're going to ultimately recognize that whatever they do, their growth rate is probably going to end up in the median growth rate for firms that succeed and that are still alive 15 years later. Okay, so that's going to contrast with our decision for return. Right? It is totally reasonable for me to look at a company's return now and say, oh, they're making a 15% return. Well, that's a pretty good assumption that they're still going to be making a 15% ROIC 15 years from now, 20 years from now. Growth rate, it's the opposite. If they're making a 15% growth rate right now in their cash flows, we should assume that 15 years from now, it's more than likely fallen to about 5% in the next 15 to 20 years. And it's going to fall even faster than that. But by the time we get to 15 years, you can see that this is just a mishmash. You can't pick one quartile out from the other. Okay. So this graph tries to show that with firm specific, or this matrix tries to show that with firm specific. And I just want to show you, so down here on the bottom, it's revenue growth over 15-year period. What we're trying to measure is, do firms sustain high growth over a long period of time? And what you can see is that they don't. And this is sort of me just beating a dead horse. I'm trying to show you what I just finished telling you in a different way. So I won't continue to beat the dead horse and do it again. Okay. All right, so that's all I got for chapter 7. Again, this chapter and chapter 6, really important, because these are even though we haven't started to talk about how we do these models in practice, the whole point of the model is that we're trying to answer questions for managers, and we're trying to help them devise strategies for running the company that create value in the long run. And then we'll do our model and we'll show them how the value is created and how much value is created. But the strategies that we just finished talking about, these are the guiding forces for firms and their behavior. So we really need to keep that in mind as we start to look at the model in practice in the next chapter. Now, that being said, the next chapter, chapter 8, is like absolutely the most important in the class. I want you to watch the lectures. We're going to work a big example. I'll do it on Excel. I'm going to show you in practice exactly what working this model looks like. This is where we do what we're talking about. So you will be totally lost for the rest of the class. So please keep that in mind. Okay, see you next week.